Hey there, fellow traders! Today we're diving into the exciting world of intraday swing trading. This is a strategy all about grabbing quick profits from short-term price swings. Now you might be thinking, Jim, isn't that just day trading? Not quite. Day trading is like a drag race. In and out, fast and furious. Intraday swing trading is more like a NASCAR race. We're in it for a few laps, not just a quarter mile. We hold trades for a few hours to maybe a day, riding those momentum waves. The beauty of this? You can react to market moves in real time without being glued to your screen all day. It's perfect for those who work or have other commitments but still want a piece of the trading action. So, buckle up, we're about to explore the strategies and techniques that can turn you into a successful intraday swing trader. Listen up, traders. The first rule of intraday swing trading is simple. Trade with the trend. It's like surfing, you wouldn't paddle against a tsunami, would you? An uptrend is your friend. Look for stocks making higher highs and higher lows. A downtrend means caution. Look for stocks making lower highs and lower lows, and remember those range-bound markets? They're like the ocean on a calm day, not much opportunity for surfing. Why is this so important? Because trading with the trend puts the odds in your favor. It's like having the wind at your back. You're not trying to predict tops or bottoms, just riding the momentum. Remember, even the best surfers get wiped out sometimes. But by following the trend, you're increasing your chances of catching that perfect wave and riding it to profit. Now let's talk about high probability setups. These are like your secret weapons in the intraday swing trading game. They help you identify those sweet spots where the odds of a profitable trade are in your favor. What makes a setup high probability? It's all about confluence. That means looking for multiple signals lining up like a perfect storm brewing. For example, you might see a stock breaking out of a key resistance level on high volume, with the RSI indicator showing bullish momentum. Remember, no setup is foolproof. But by focusing on high probability setups with strong confluence, you're tilting the odds in your favor. You're like a skilled poker player who knows when to hold them and when to fold them. In intraday swing trading, timing is everything. You need to be in the right place at the right time, just like a seasoned fisherman casting his line. That's why choosing the right time frames and stocks is crucial. For trend analysis, start with daily and hourly charts. These provide the bigger picture of where the market is heading. Once you've identified the trend, zoom in to shorter time frames like 15-minute or 5-minute charts for precise entries. Now, let's talk stocks. Liquidity is key. You want stocks that trade with high volume so you can easily enter and exit your positions without getting stuck. Look for stocks with a tight bid-ask spread indicating strong liquidity. Remember, in the fast-paced world of intraday swing trading, every second counts. Choosing the right time frames and stocks will give you that crucial edge you need to succeed. Section 5. Breakout pullback, catching a stock on its second wind. One of my favorite setups for intraday swing trading is the breakout pullback. It's like watching a thoroughbred burst out of the gate, pause for a breather, and then charge ahead with renewed vigor. Here's how it works. You identify a stock that's been consolidating in a tight range, building up energy. Then, bam! It breaks out of the range on high volume, signaling strong buying pressure. But here's the key. Instead of chasing the breakout, you wait for the pullback. This is where the stock takes a breather, shaking out weak hands. Once the pullback finds support near the breakout level, that's your signal to buy. The breakout pullback is a powerful setup that combines momentum and patience. It's like waiting for the perfect moment to strike, just like a seasoned predator. Section 6. Moving average bounce. Trading with the momentum. Another fantastic setup is the moving average bounce. This strategy is all about riding the waves of momentum, just like a surfer catching a perfect swell. Here's the deal. You identify a stock that's trending strongly, either up or down. Then, you plot a key moving average on your chart, like the 20-period or 50-period moving average. When the stock pulls back to the moving average and bounces off it with strong volume, that's your signal to jump on board. The moving average acts like a support level in an uptrend and a resistance level in a downtrend. Remember, momentum is your friend with this strategy. Look for strong, decisive bounces off the moving average, not weak, hesitant ones. Ride that wave until the momentum starts to fade. Section 7. RSI divergence, spotting the turning points. Now let's talk about a powerful tool for identifying potential trend reversals. RSI divergence. This technique is like having a crystal ball that helps you anticipate market turns before they happen. The RSI, or Relative Strength Index, is a momentum oscillator that measures the strength of price moves. Divergence occurs when the price action and the RSI are telling different stories. For example, imagine a stock making new highs while the RSI is making lower highs. This bearish divergence suggests that the upward momentum is weakening and a reversal could be in the cards. Conversely, bullish divergence occurs when a stock makes new lows while the RSI makes higher lows. This suggests that the selling pressure is easing and a bounce could be on the horizon. RSI divergence is a powerful tool that can give you an early warning signal of potential trend changes. Remember, it's not a foolproof indicator, but it can significantly enhance your trading decisions. Section 8. Risk Management, Protecting Your Profits. Listen up, traders. Risk management is not glamorous, but it's the most crucial aspect of trading. It's like wearing a helmet when you're riding a motorcycle. You might not need it every time, but when you do, you'll be glad you have it. First and foremost, never risk more than 1 to 2% of your trading capital on any single trade. This way, even a string of losses won't wipe you out. Remember, it's a marathon, not a sprint. Next, use stop losses religiously. These are your automated safety nets that limit your losses on a trade. Place your stop loss just below a recent swing low in an uptrend or above a recent swing high in a downtrend. Always aim for a favorable risk-reward ratio. Ideally, you want your potential reward to be at least twice the risk you're taking. This way, even if you win only half your trades, you'll still come out ahead in the long run. And finally, avoid overtrading like the plague. It's like eating too much candy. It might feel good in the moment, but it will ultimately leave you feeling sick. Stick to your trading plan and only take trades that meet your criteria. Remember, protecting your capital is priority number one. By implementing sound risk management techniques, you'll be able to weather the inevitable storms and come out stronger on the other side. Section 9. Common Mistakes and Final Checklist. Alright traders, let's talk about some common mistakes to avoid. These are the pitfalls that can trip up even the most experienced traders, so pay close attention. First up, avoid chasing trades like your life depends on it. Remember that old saying, the early bird gets the worm? Well, in trading, it's often the patient bird that gets the fattest worm. Next, never ignore your stop losses. I know it's tempting to move them further away in the heat of the moment, but trust me, it's a recipe for disaster. Stick to your plan and let your stop losses do their job. Avoid trading low-volume stocks like the plague. These stocks are illiquid and can trap you in a trade, making it difficult to exit at your desired price. Stick to high-volume stocks with tight bid-ask spreads. And finally, never give in to revenge trading. We've all been there. You take a loss, and you immediately want to jump back in and make it back. But this emotional trading can lead to bigger losses. Take a step back, breathe, and only trade when you're thinking clearly. Final checklist before entering a trade. 1. Trend. Is the stock trending up, down, or range-bound? 2. Setup. Do you see a high probability setup with confluence? 3. Time frame. Are you using the appropriate time frames for analysis and entry? 4. Liquidity. Is the stock liquid enough for easy entry and exit? 5. Risk management. Have you defined your risk, set your stop loss, and determined your profit target? If the answer to all these questions is a resounding yes, then and only then should you consider entering the trade. Benefits of intraday swing trading flexibility. Trade around your schedule without being glued to your screen all day. Potential for quick profits. Capitalize on short-term price swings for rapid gains. Reduced overnight risk. Avoid holding positions overnight, minimizing exposure to unexpected news and events. So there you have it, folks. By mastering the principles and techniques we've discussed today, you'll be well on your way to becoming a successful intraday swing trader. Remember to be patient, disciplined, and always manage your risk. Now go out there and make some money.